Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at a requested stock. And this is ASML Holdings, ticker ASML. And this looks to be a pretty good growth stock, currently trading for a little over $1,000, but I'm only coming up with the fair value in the high 500s, and cash flows are not looking good on this one. Earnings yield 2.7%. Clearly, it is a very expensive stock for what you're getting. We'd be wanting a EPS of 51.4 for that kind of price, and what we're looking at is 20.77 this year, 32.33 next year. So I don't think that's something that we're going to see for another 4+ years at least. Cash flow yield was low this last year. Usually they're around 27%, and they came in at 9.11. Cash flows are something that have been dropping here. They had a really good year in 2020, a pretty big pullback in 2021, and a huge drop in 2022 that continued into 2023. So we're hoping that they're either going to level out or start picking it back up from here. Very small dividend, 0.62%. Yield this last year, usually 0.88. Payout ratio of 35.71. So they are paying out a reasonable amount. We look for that to be 30 to 50. It's towards the lower end of that range. So they do have a bit more room to grow it. All of the returns look really good here. Almost 53% ROE, but debt to equity is almost 2. So their debt is pretty high. ROI, amazing, almost 20%, and ROA, almost 18%. So the assets that they do have a pretty good return on them. Margins seem to hold pretty steady around 51.5 for the gross, and for the net, on average 28.5. This last year they came in a little lower at 27.23. Now, analysts are expecting some pretty good growth over the next few years. It seems like it's slowing down at the moment, where compound annual growth over the last 2 years, 7.23, last 3, almost 12%. But analysts are expecting 15.5 and 23.5 over the next 2. So we're going to use 17 for our thesis, somewhere in between those two numbers that analysts are coming up with. Next up would be share count. They buy back a decent amount of shares. I am sure that it's lower in the 2-year than the 3-year because the share price is pretty high. So if we're looking at a pullback in this thing, they could probably go up as high as 1.5%. Looks like 0.75% to 1% would be pretty fair here. So we're going to go with that 1%. Cash flows, like we said, they're shrinking, but even growing revenues at 17%, 10% growth in the value of those cash flows would drop their cash flow yield to 6.7%, which is low. That's definitely lower than we'd like to see. So we'd hope that at a minimum, we could come up with something like this. Ideally, they're growing at 25+%, something higher than those revenues that can get that cash flow yield back up. Assets, 13.5, just shy of 10. We're going to go with 10 there. And liabilities, 25 and just shy of 10. We're going to go with 11 there. It does seem to be a little bit higher, which doesn't bode well for that debt to equity. It's probably part of why it's so high. Dividend, we're going to put 10% to start with, and then margins, small margin growth, they've been holding pretty steady where they're at. And what all this gives you, with dividends factored in, 16.65% annual growth in the fair value. Which, buying at today's price, you're underwater in the 3-year, and in the 5-year, you're not underwater, but you're not performing in line with the markets. Maybe about half, less than half of what we'd expect from the markets, which is about 47%, and that 8 to 10% annual returns that we look for. So you'd have to get in at a better price, and the fair value here would be an amazing price to get in at. It has been that low in the last 52 weeks. You'd be more than doubling the returns in the 3-year, and in the 5-year, again, you are more than doubling returns. You're getting about 150% of what you get if you just invested in the SPY. So I do like the potential here, but those cash flows need to turn around, and that balance sheet needs to turn around. So we'll take a quick look at the price chart here, and then we'll come back and we'll do a best case and a worst case scenario. So it looks right here, balance sheet is what's dragging the value down a lot. It's pretty steady down here, bringing in a little over $100 worth of value. And that's what we saw. And cash flows have been trending down and are almost meeting it down at that point. And that's why we see that the discounted cash flows is really low, almost $200. Cash flows just have not been performing very well here, and neither has the balance sheet. But operationally, the earnings look really good. And that's this red here. So you can see next year that is way out above any other valuation metric. Share price seemed to stagnate in 2022, not really pushing up. And the fair value of the stock, again, it's trading in a bit of a range from 2022 to 2024, but it's pushing up along with those earnings. The dividend is staying pretty flat with that just shy of 1% yield, and the share price has been on a pretty good run, hit a peak 2020, pulled back, and right now it's up higher than that 2021 peak. So now we'll come back to things and we'll take a better case scenario. Analysts are expecting over the next 2 years 23.5%. So we'll see what that'll give us. Share count, maybe they can come in with a 1.75% buyback. We've seen them go as high as 1.88. Cash flows, slight outperformance of the revenues to start getting the cash flow yield up would be a best case scenario here. I don't know that they're going to grow it super fast, but that gets them up to 9.3% over the next 5 years. Maybe a bit better than that. 9.7. Assets, best year, 13.5. Liabilities, well, in this case, the best year would be the lowest number, 9.75, around there. And then dividend growth, 15 instead of 10. Margins, 1%. All of this, if you were to buy at today's price, you're no longer underwater in the 3-year. You're underperforming the market by about 20%. But in the 5-year, you are now outperforming by 17%, with an average annual return of almost 24.5%. So this is probably something more in line with the thesis for someone who's buying the stock at today's prices. If you think that this kind of situation is going to happen, then it's probably reasonable to at least start a position, and then you'd want to look for something a bit lower, under 1,000 probably, to get at least returns in line with the market in the 3-year as well. But now let's take a look at a worst case scenario and see if things don't perform well if you're going to be underwater in any of the time frames. So 7.25 was their lowest here. If they don't buy back anything, that'd probably be worst case scenario here. I don't see them issuing. The cash flow growth, has to be something lower than the revenue growth for our worst case scenario. In fact, we've seen them go negative 30% over the last 2 time frames, so we'll go with that for a worst case scenario. Assets, you're only growing 9.75. Liabilities, you're growing 25.5. Dividend, we'll go with 5. The reasonable case, we went with 10. And margin holds steady. Maybe a small drop. I guess the historical one isn't quite as fair. And this gives you still really good annual returns, 11.36%, but you are underwater in both time frames. You're almost losing as much as you'd gain if you invested in SPY over the next 3 years, and then almost breaking even in the next 5 years if you're buying at today's price. So again, you'd probably want to buy something a bit lower, maybe more in line with 1,000 or less. So let's just go $9.99 and see. See, now you're essentially breaking even in the 5 year. So really, you'd want $9.50 or less to have a decent margin of safety. Where worst case scenario, you're not underwater. It might take a while for the stock price to get back up to what you bought in at, given a drop, but you're not catching a falling knife. And then if you really want returns in line with the markets in the 3 year, that's simply buying in at 775 or less. And now you're almost break even. You're just over break even on the 3 year. And in the 5 year, you're still underperforming the market by 20%, but definitely not underwater. So this is definitely one that I'll place on a watch list. I do like the growth that I'm seeing. Even worst case scenario, returns look good, outperforming market returns. But I want to see them working on that balance sheet and getting those cash flows to, at a minimum, level out at this level and start to go back up. So that's all for this one. I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at and subscribe so you can stay up to date with everything. And I'll catch you next time.